Hey Deriv traders, welcome back to another video tutorial. On this lesson, you are going to learn how liquidity works and how institutional traders exploit liquidity to enter and exit positions effectively. Liquidity refers to the availability of buy and sell orders in the market, and it is often thought of as fuel for price movement. In essence, for price to push up, there should be some sellers that are willing to lose to the buyers. And for price to push down, there should be some buyers that are willing to lose to the sellers. As usual, we need to start off with the basics. You need to understand that everything stems from market structure. Now here on these diagrams, we have a downtrend and an uptrend. In a downtrend, we already know that the sellers are in control whenever price is pushing down. And in an uptrend, the buyers are in control whenever price is pushing to the upside. But in the supply and demand lessons, we understood that from these highs and lows, there are some buyers, like from the lows, there are some buyers that are getting involved in the market in order to push price to the upside. Now, on the highs, there are some sellers that are getting involved in order to push price to the downside. Now, whenever these people are buying and selling, we need to understand on where do they place their stop losses. Obviously, for buyers, so for the people that are buying, they will obviously be placing their stop losses below the low. And for the people that are selling, they will obviously put their stop losses above the high. Now, on each and every high or low within the market, there is liquidity because that's where a lot of people tend to place their stop losses. Now, the same is true in terms of an uptrend. From these lows here, there will be people that are buying, and from the highs, there will be people that are selling. Now, whenever the buyers are buying in the market, they will be placing their stop losses below the lows, and for everyone that will be selling, they will be placing their stop losses above the highs. Now, each and every time whenever price creates a break of structure, we need to understand that whenever price is in a downtrend, the liquidity that's resting above the highs will obviously be protected each and every time. So that's the main reason why we hardly see price violating the highs whenever we are in a downtrend. Now, however, the liquidity that's resting below the lows gets taken out each and every time whenever we are in a downtrend. So basically, the market will entice people to buy from the lows whenever price is in a downtrend. When they place their stop losses below the low, price will then push to the upside, and then people will think that price now wants to be bullish, but only to find out that the sellers are in control and they will be selling from the highs, placing their stop losses above the high there. Now, whenever they push price to the downside, the main goal is to go and grab the liquidity that's resting below the low. So that's the main reason why each and every time whenever price is in a downtrend, we know and understand that the main goal is for price to eventually invalidate the low. But now we understand that whenever price tries to invalidate a low, it's simply because there is a lot of liquidity below that particular low. Now the same is true in terms of an uptrend. Whenever people tend to sell from the highs, they'll be selling with the idea that price will significantly push to the downside. But eventually, in an uptrend, we already know that the buyers are in control. So whenever the buyers will be buying, they'll be buying from around this area here in order to push price to the upside. Now, the main reason why they will be pushing price to the upside, it's simply because they want to grab whatever liquidity that's resting above the high. Now, when this happens each and every time, we need to understand that the lows are hardly broken simply because, the big fund institutions, they always want to protect their positions or their stop losses. So that's the main reason why price doesn't break the lows whenever price is in an uptrend. So price will always try and grab the buy side liquidity whenever price is in an uptrend, and whenever price is in a downtrend, price will always try to grab the sell side liquidity. Now let's head on to a live chart and we see on how we can go about implementing these. Now from these highs and lows here from this chart, we need to understand, as you know by now, that from these highs and lows there are some buyers and sellers that are getting involved in the market. Now from this particular low here, we need to understand that from this low here, we need to understand that there are a lot of people that are actually buying around this low. But now, where are they placing their stop losses? They are placing their stop losses below the low, right? So they're placing their stop losses below the low. Now, initially price was in a downtrend, which means that the the liquidity that's likely to get grabbed is what is the sell side liquidity. Now, for everyone that bought around this area here, there is a high chance that they will get taken out in the market. They will become liquidity. So when price was in a downtrend, obviously from the highs, there are some people that are doing what? There are some people that are selling. Now, when people sell here, they will be selling and placing their stop losses above the high. Sorry about that. They will be placing their orders and then placing their stop losses above the high. Now, the minimum target should be the sell side liquidity each and every time whenever you are trading. Now, from this low here, you need to understand that there are some breakout traders, right? So each and every time when price grabs liquidity, the sell side liquidity, price will try by all means to return back into the range. Now, what do I mean by this? After each and every break of structure, price needs to return back into the range. Now, as you can see here, obviously when price is breaking this low here, now what's going to happen? A lot of people will be seeing this as a sort of like a continuation. So they will be selling, the breakout traders will be selling around this area here and then placing their stop losses slightly above this particular low. Now, what will happen here? What will happen is that these people will also become liquidity. The breakout traders will become liquidity because now the objective has been completed. You need to understand that the main target for this is that price wanted to go and grab the sell side liquidity. So these breakout traders will also become liquidity because price will eventually return back into the range. Now, when price started pushing to the upside, you need to understand that from this low here, there are some buyers, right? Each and every high or low, there are some buyers. And for price to push up, there should be some sellers that are willing to lose to the buyers. So around this low here, these are the sellers, right? So there will be breakout traders. These are the sellers that will be willing to lose to the buyers. Because around this area here, there are some people that are actually buying from around this area here. So whoever was selling around this area here will become what? Will become liquidity. So price eventually gets pushed to the upside. Now, when price pushes to the upside, we eventually take out the high. So the sellers are no longer in control because we are now creating what? We are now creating a trend change. Now, there will be some sellers that will be selling from this high here. But now we understand that the trend has transitioned. The sellers are no longer in control and the buyers are currently stepping into the market. So there will be some sellers from this high here, hoping that price will significantly push to the downside. But unfortunately, they will become buy side liquidity. Now, the main goal here, whenever price starts creating a low, right? So you need to understand that after price creates a low, there will be people that are buying. So people will be buying because now the buyers are in control, placing their stop loss below the low. Now, what will be the target? The target will be the buy side liquidity. So the target will be to target whoever that was selling around this area here. So they will try by all means to go and take out those people. Now, as price pushes to the upside, grabs the liquidity, you need to understand that around this high here, there is what? There are some people that are looking to buy the breakout. Now, whoever will be buying the breakout, they will be placing their stop loss slightly below this breakout here. They will eventually become liquidity also. Why? Simply because price, after a break of structure, do not forget what I mentioned, after each and every break of structure, price needs to return back into the range. So if price needs to return back into the range, it means that from the high, people will be selling. And whoever that will be buying the breakout there, they will become what? They will become liquidity. So the sellers will be placing their stop loss above that high there, and then maybe they will think that price will significantly push to the downside, but eventually what happens to them? They will eventually become liquidity. Why? Simply because the price right now is in an uptrend, the buyers are in control, so obviously price will always try by all means to protect the sell side liquidity, and then it will always try and grab the buy side liquidity. So from this low here, as you can see, the previous low doesn't get violated, but it doesn't mean that it doesn't have any liquidity. It has a lot of liquidity because a lot of people are placing their stop losses below this low here. A lot of people are placing their stop losses below that low. But because the buyers are in control, this sell side liquidity here will get protected each and every time. So we won't be seeing price violating the lows. Now, after price creates this low here, obviously there will be some buyers stepping into the market. The big fund institutions will try by all means to protect whatever positions they have from the previous low. Now, they'll try to buy again and put their stop losses below the low. Now, what will be the target now? The target will be the buy side liquidity. Everyone that sold from this high will become liquidated. So as price pushes to the upside again, once we create that break of structure, again, the same logic. There are some traders that will be looking to buy the breakout, and then price will be pushed to the downside to take out the liquidity from what? From the people that will be buying the breakout. Now these people here will become what? Will become the buy side liquidity. So everyone that will be buying the breakout, they will be placing their stop losses below the breakout there. And then we know and understand that after each and every break of structure, price needs to return back into the range. So if price needs to return back to the range, there are some sellers, right? So there are some sellers that will be selling around this high here, hoping what? Hoping that price will significantly push to the downside. Now, when this happens, these people here, they don't have any idea that price will significantly push to the downside, will eventually significantly push to the downside. They don't have any idea. So now the buyers, right, the buyers are now losing control. Why? Because we see the sell side liquidity getting grabbed. So whoever bought around this area here, holding their positions, hoping that price will significantly push to the upside indefinitely, they eventually become liquidity. So each and every time liquidity needs to be grabbed one way or another, because everyone that was buying here, that's if they are still holding their positions. Do not forget that I mentioned that in an uptrend, even on these lows, there is liquidity, but whenever price is in an uptrend, the liquidity needs to be protected. So we won't be seeing price violating the lows because price is currently in an uptrend. Now, whoever that sold here, obviously there is some buy side liquidity around that high there, but now the buyers are losing control and the sellers are stepping into the market. So whatever lows that you see here that have been protected, the liquidity will most definitely get grabbed now. So as you can see, price eventually creates a trend change. Obviously around this area here, what will be happening? There will be some people looking to sell the breakout around this area here, right? And then where will be they placing their stop losses? Above the breakout there. Now we know and understand by now that after each and every break of structure, price needs to return back into the range. Now as you can see, price returns back into the range, and then there are some buyers here, right? So there are some buyers around this area here. So these buyers, the sellers that will be selling around this area here, will become liquidated by the buyers that are buying from this low. Now these buyers here, because they don't know who's in control now, we know and understand that the sellers are in control. So these buyers here are more likely to get liquidated. Now, as you can see, when price pushes to the upside, what happens? The buy side liquidity now is protected. So everyone that's sold around this area here, their stop losses are now getting protected. So price doesn't invalidate the highs. Why? Because price is in a downtrend. So the sellers are in control. So the highs will get protected. They won't get liquidated. So whenever price starts pushing to the downside, again, people will be selling from the high around that area there, placing their stop losses above this high. Now, what's the target now? The target will be the sell side liquidity. Anyone that will be that bought around this area here, so they still have their stop losses below this low. Obviously, price will need to go and grab that particular liquidity. Anyway, guys, I just hope you understand now that liquidity is everywhere. Liquidity resides on every high or low in the market, and you just need to understand on what's happening on these highs or lows. You need to understand that for price to push up, there should be some sellers that are willing to lose to the buyers, and for price to push down, there should be some buyers that are willing to lose to the sellers. Anyway, I just hope you managed to um, get an insight on how liquidity works within the market. And at a later stage or in the next lessons, we'll try and, introduce some more complex things on how to go about spotting potential areas of liquidity and so forth, and on how those potential areas of liquidity, they have a high chance of getting invalidated or getting liquidated before price pushes in a particular direction. Now that's it for today's video. If you found this guide helpful, don't forget to hit that like button, subscribe for more trading tips, and drop any questions or topics you'd like to see in the comments below. You can click here to watch my recent upload, or click the playlist to watch more content on market structure. Anyway, thanks for watching and happy trading.